Indiacharts publishes Nifty daily video updates, the weekly Elliott Wave outlook, and the long short report covering all asset classes.
Rohit Srivastava from Indiacharts taking you through the market action on the 2nd of June 2020. I'm going to discuss what we are looking at the weeks and months end and what's really transpired, because it looks like a lot of people are confused why the market's really headed higher, and the bigger question that I get asked over and over again, and I have my answer, is what's going to happen after this bump up in the markets. I mean, isn't it going to crash and go back all the way to 7,000 or 6,000? And the standard answer to that on all my social media posts seems to be yes. And so that's where I think it ended up being a really big contrarian call, because if sentiment is lopsided completely to one side of the arena, then the markets are most likely going to do something else. Now, usually, of course, you cannot just go by a few answers on posts and here and there, because that is just a few thousand people in the entire market really responding to what you're saying. But it was pretty glaring this time, because I've never had 80 to 90% of the comments on a promoted Facebook post saying that the market's really headed down. So that was a very, very unusual feature in the month of April. So even in April, I started out by looking at this only as a counter trend bounce, which is what I think everybody is thinking too. But along the way, I started to discuss in my mind that maybe something else is at foot over here. Some of it also is part of the narrative that I actually put out in September of last year. So September of last year, after the mid-cap crash, I had started to anticipate that the markets would reflate somewhat and probably go higher, initially to 11,800, then to 12,300, and then I was open to the idea we could go both ways at least. By budget time, we expected maybe a short-term correction, but later on things completely changed. But what was the narrative back then is that you'd already been through 1.5 years of a bear market in mid caps, and so that now has extended to a 2-year period. You've been through a 4-year bear market in the pharma sector, you've been through a 2-year bear market in the auto sector. So there are several sectors that have been through either a significant drawdown or a significant time-wise bear market, which really called for a contrarian stance. You also look at the Nifty itself, it had a pretty steep correction. So I would have thought, once I got onto the bear side in Feb, that this sell-off would go down to maybe 10,500, then it would go back to 11,200, then down to, and so on, and probably end up at 8,500 eventually. Now we ended up at being at 7,500 all in one shot. So the big difference is, instead of a prolonged multi-legged bear market, we ended up getting what was a one-shot all-in-go sell-off. And so this is where I start thinking about whether you're going to continue and go back down again, or probably you should wait before you take that view, simply because you've got a panic reaction. In fact, to some extent you can say you've got a selling climax, because it's huge volume. I mean, there was huge volume in each of the sell-offs. When you actually go back and look at 2018, then you go to 2019 post the Modi election, when I wrote the Modi Bubble 2.0 long short report. And then you look at the volumes now. So each time, each sell-off, the volumes kept on increasing exponentially, and this time around they are probably the highest in years. In several of the banking stocks, they are highest in, they are all-time highs. In fact, just look at IndusInd Bank volumes, where they used to do 80,000 shares, 1 lakh shares, best day probably 2 lakh shares. It's doing 1 million, 2 million, 3 million shares a day. And that means for every seller in each of these stocks, whether it's Bajaj Finance, which I also posted on social media yesterday, you're getting huge exchange of hands. So essentially, for every seller there's a buyer. Okay, and so you can't only look at one side of the equation, you start looking at momentum indicators which showing waning momentum. So the declines in these stocks are occurring, and not just these two, I'm talking broadly of the market as a whole, so I'm not saying specifically for any particular stock. You can see declining momentum on the way down, which is what you saw in the Bank Nifty, which retraced maybe 80% of the gains it had ended up making in April on increasing volume. So essentially that's a selling climax, where a lot of selling volume ends up happening, and then the sellers get exhausted, and once they are, then whatever buying is there drives up the market. So I think that's what you're really seeing right now. Short selling may not be that extensive. I mean, probably more in retail than in the large players, because of all the SEBI restrictions that came in from March itself. So that would have played a role in fact bringing down positions significantly. We also had the steep discount in Nifty, which can be argued in many ways, because historically the Nifty has always shown a 25-point discount in around June on the back of dividend payments. Now this time around you ended up getting an 80 to 100-point discount, at least that's what it was looking on Friday. And the reasons could be multiple. I heard different answers, some of it based on interest rates and margins. But your simplest answer could end up being, oh well, there are shorts in the market, and then where are they, which really need to get covered, because it's very unusual to see this kind of a discount in the Nifty in the current month. Usually in a normal rising market you end up seeing 30-40 points premiums, and mid-month you usually see around 20 points or 15 points at least, and here you're looking at a major discount. So that was a signal that something's not right, and if it's a short squeeze going on, then probably it means there's more upside left. Now what you may get in a day or two, maybe a short-term reaction, because one of my proprietary swing indicators has reached a 94% bullish reading, which means that most stocks are showing an advance, and when that happens you typically get a 1 to 2 pause or some consolidation at that price range. So I would have liked to see this move continue to maybe 10,160. 10,160 is where you left the gap behind when markets were falling in March. So when you had the crash in the first week, there was a sharp sell-off where you got a gap down and then it bounced back. I think one of the biggest one-day upward candles occurred there before it sold off again, and then it stopped at 10,159. So above 10,160 is a gap, and that gap goes on till I think somewhere around 10,300 and something. So in that range, that 150 point range is where the next resistance is. But probably because of this swing reading, we may not go to that gap range right away. We may pause for a day or two and then go there. So which means, yes, I do continue to expect upside. I think typically anybody should now look at the 61% retracement of the entire fall. If you take the decline from Feb, it's at 10,430. If you take it from the all-time high, then it's at 10,550. So those of course become initial levels, but the big question is, will you stop there and go right back? I think there are the knowns and there are the unknowns. So the knowns are, well, there's going to be bad, poor GDP data, there's going to be poor earnings numbers. I think those things are already known, and if those are the reasons why you're thinking that the market is going to go back down because all news on the economic side is going to be bad, then you're probably mistaken, because the market already knows that. Everybody knows that. It's not new news. It was known around the world when the April results were coming out in the US. The same kind of scenario existed. They're saying results will come bad. Well, they came bad and the markets went up. And the reason is you already know that information. So all you end up getting is a one-day reaction, and the markets end up being forward-looking. So they're really looking at this reopening shape, how it's going to take place, and many other parts of the world, unlike India, there's actually not just monetary stimulus, but there's also fiscal stimulus. Because when you wind back to Jan of 2020 or a little before, the pressure was already there and economies had already slowed down and monetary policy action had already been taken. So what you're really seeing now is an attempt at fiscal policy, something they were already talking about back then. They were talking about MMT, direct money transfers and so on. A lot of that was there in various published reports and recommendations to the Bank of International Settlements and the Fed discussions and various news reports. But eventually you had the governments to take action, and I think this COVID crisis has provided the excuse for all the governments to really go out and start taking that kind of action. So the main criticism this month for India was that India did not end up taking the same kind of measures that many other places have done, or at least the US has done, where they've gone into trillions more of debt just to stimulate their economy. So I think that pressure is now will continue to build up. I think my sense is, looking at just the commentary from the government side, that they wanted to only take steps that would have a direct impact at this point of time, and anything that they would do when the economy is closed down would not have an impact. So probably they would have something in the pipeline in the weeks and months ahead once the economy opens up from the lockdown. So I think that is my way of looking at it. The other one is now that you've got the Moody's downgrade yesterday, I think it will give an additional reason to really take action on the economic side with further measures. So I think we have the reasons in place. We're just not seen it yet, and so probably we don't expect it. But put it together, if you have the whole world taking steps on the monetary and fiscal side, whether India does it or not, you actually see a much larger amount of money and liquidity floating around, and that could be one of the biggest drivers of why various financial markets are actually headed higher. Today itself, we are watching the DAX almost up 4%, after the Nifty's ended up a couple of percentage points, which is I think almost over 500 points on the Sensex. So pretty big moves that we are beginning to get now on the upside, which like I said, short-term correction possible because of the near-term overbought reading, but you should see this pattern probably continue because of various reasons, not just liquidity. There could be a mild short squeeze, there could be pent-up buying from people who finally realize that they've missed out, so what you call the FOMO kind of action, because what you got in this sell-off, and like I said earlier, after a 2-year bear market in the mid-cap stocks, in fact I should say more than 2 years now, almost 2.5 years, some of the valuations are really reached bottom end. So the big question becomes, do you really step in now, or will valuations get worse? I think this is probably end up in hindsight looking like one of the best value buying opportunities in particular stocks and sectors since 2013 or 2008. So those are the two previous price points where the relative strength of the mid-cap stocks was where it is today compared to the large cap. So that's what I put out in the long short report. I did a long short webinar last weekend for all the subscribers that really attended it, highlighting all these facts so that they could be ahead of the curve when we pulled back to 8800, because to me that pullback, just more than a 38% retracement in the Nifty, and also seeing a almost over 80% retracement in the Bank Nifty, gave a very, very similar setup to what we've seen at least one point in the past, which is 2008, when you compare the Sensex to the Nifty. So I put out this chart on social media comparing both of these indices, the Sensex along with the Bank Nifty, just to show you. Of course, the current period is a little more compressed, so when you look at this pattern, you are looking at it over a 2-month time horizon, whereas in the past we are looking at almost a 4-month time horizon. But it's the same thing, you got a triangle and then you started to sell off on the downside, which looked like a downward channel. You can also call it a flag in hindsight, but it did not carry to a new low. So this was the similarity between what Bank Nifty did then and what Sensex did back then and what Bank Nifty did just right now. The other thing which was visible at that point of time was an intermarket divergence. So in 2008, the Bank Nifty actually ended up making new lows along with the mid-cap indices all the way into March of 2009. Whereas the Nifty and Sensex, which had bottomed in October of 2008, did not really carry on to a new low. They did what the Bank Nifty has done this time, which is just pull back 80%. So that intermarket divergence over a 4-month period was a very strong signal of a turn up. Now this time around, you don't have a 2-month divergence between Bank Nifty and Nifty. Of course, the Bank Nifty has dipped much more than the Nifty. But in the very, very short term, you got a very small divergence over 4 to 5 days. And I think I put out my other video also on YouTube. It's all on YouTube. So all these videos are on YouTube, some of them. So you can go and see, including my most recent CNBC interview. So there I noted the intermarket divergence in the short term over a 3-4 day period when you were close to 8800, where new lows in Bank Nifty at the 80% retracement mark were not being followed up by new lows in the Nifty itself. So that short-term intermarket divergence became the signal that we have finally made a higher bottom on the market and we have started to head higher. And so at least the near-term trade was put in place, at that point, and from there you could project the next move up to go and retest the April highs, which the Nifty is done. The Bank Nifty is still lagging behind, so I think eventually it should get there. That level is probably close to the 22,000 mark. It's almost a 38% retracement for the Bank Nifty. And probably it should then go to the 50% retracement mark, which is closer to 24,000. So that's what I would expect to play out in the weeks ahead, that the selling climax that you've really seen in the banking stocks now results in a larger reversal coming from banking stocks trying to play catch up. So even though they're at a much deeper retracement, the volatility in banking of course remains higher. So every time you see a 2% up move in Nifty, you see a 3-4% up move in Bank Nifty, even though it has not yet reached the April highs. So that's just the general volatility of banking, where they fall more and then they rise more as well, something that you need to get used to. But now they are playing catch up. So in terms of percentage terms, you're getting a bigger swing up. So all these news items, so what you're going to get over the next 1 to 2 months, I think is a whole lot of news. And so there was a pretty long argument I had, or discussion you can say, on Facebook with someone who was trying to say, well, all this news is going to drive the market down, things are not looking good, the stimulus is not up to it. And I was trying to argue back saying news is not the driver. In fact, if you just look at the pattern of the Nifty over the last few weeks, which is most of May, it was exactly similar to most global indices. Whether you look at the S&P, you look at the DAX, all of them have a flag, a downward flag. And apparently those markets completed the flag and broke out of it a week before we did. And simply because when that happened, we were still in the midst of our own stimulus package announcements, which ended up disappointing the market. So we continued to form that flag formation. It just extended on the way down, and we broke out of the similar pattern just 10 days later. And just because it's happening 10 days later, a lot of people start thinking that, we've deviated and we are not going to participate. The stimulus is not up to the mark, and this is the end of the world. So what they are not able to think is that the government can take further measures going forward, and ignore completely that the reforms that they actually ended up announcing in the name of the stimulus which they are providing, which is of course there in the form of a lot of credit, that those reforms which were not only long pending, but you would say they were both strategic and significant in nature from a long term perspective, are being ignored in terms of news flows and everything else taking over. So they've just, it's like a smoke screen. And I've seen this way back in 2002 as well, that when they came out with announcements on the EPC reforms in 2002, the market was actually in a downtrend. There was weakness, it just kept on falling. But the power stocks and companies in that sector started to base out, and people who understood that story were actually probably looking at stocks in those segments. And similarly, when they announced the golden quadrilateral, I think market simply had no idea where to go, and infrastructure stocks are just languishing at that point of time. So this is what really happens, because there's other news driving markets in the short term that we completely overlook the impact of what the potential reforms will be on a 1 to 2 year basis, and are overtaken by what is happening in the 1 to 2 month time horizon. So I think that's what has happened as far as news flows are concerned, and it continues that way. So if you have this Moody's downgrade, so this whole argument on Facebook was on news drives the market, and so you have a Moody's downgrade. Now by that logic, the market should have crashed today, whereas it's significantly up again for one more day. Then you have other news flows which are happening right now. You had the China-US dispute, which is almost many years old now, and every time that dispute comes up, markets end up reacting for a few days and then continue to do what they are really going on doing. So that's what we've seen over and over again, and it's become a pattern almost that you stop discounting the news. You try to look at the trend, and if the trend is up, then most news gets discounted. Negative news in a day or two's reaction, sometimes you get no reaction. Now you have US riots going on, which are also not really having a direct impact on the US. Now you can end up saying that, well, this is all because of the stimulus, which you shouldn't rule out, because there's a lot of liquidity and that is driving up financial assets. So let us not undermine the impact of liquidity on the whole big picture. At the same time, look at what liquidity really means for markets, because finally we are looking at financial markets to end up making a living out of it, or earning or creating wealth, various different objectives that each one has, which you are trying to achieve. And if you are looking at those objectives from a long-term basis, then you really need to look at not just the day-to-day news, but for where you're in the big picture. And in the big picture, I've come to the point where, apart from all these short-term news flows, which again, my argument is news really follows the market. So that's something you need to learn before I end that part of the argument and go to the next, is that news flow follows the market and doesn't lead it. So usually markets start selling off and then news follows. Now this may have been an unusual case where you can say COVID started right at the peak, but Indian markets had already peaked in Jan. Many other markets were already down. I think it was only the US that was standing out simply because of all the repo-based liquidity injections by the Fed. So eventually all of that moved by this action. But most of the other times you'll find that markets are ahead. So for example, if you look at the sell-off post-stimulus, so it was not up to the mark, but the peak was done at the end of April, right? So in the last week of April, last day of April, you'd already topped out before the market was disappointed by the stimulus. So if you look at it that way, you will end up appreciating that markets were ahead of that announcement as well. So moving from there to the next key trigger, okay, so apart from all liquidity and the lack of fiscal announcements in India, this is the next big trigger which you need to probably focus on, and it is the potential for lower interest rates in India. Now, transmission of interest rates in India has been an issue for very, very long. I think to some extent it may continue to be an issue, but there is clear-cut action over the last year from the side of RBI to make this happen through its LTRO program, additional bond buying that it has been doing since March. So far, almost 180 lakh crore worth of bond buying is probably doing that on an ongoing basis. and so it's trying to bring those yields down. You may see the shorter term tenure G-Secs actually trading at 3.5% or so, and eventually I think now even the long, so the 10-year is also now come below 6%, and 6% is where you have the trend line which is coming all the way from the 2002 bottom. So now that you're breaking that trend line, okay, it's and so as long as you sustain below 6% on the 10-year, it's a clear indication that something has changed. So my own opinion that yields would spike, and that was based on the existence of this NPA and NBFC crisis, both of which were languishing since 2015 onwards. I expected one last spike in bond yields, which happened post demonetization. So I think demonetization in hindsight was the first attempt to bring down yields, because it led to a lot of cash flowing back into banks and buying bonds, and bond yields actually dropped sharply, but then they found a base and started to rise. And then you had the NBFC ILFS case, and that fiasco was seen similar to the Lehman crisis, where you finally allowed one institution to fail. But right after that, this year, RBI said we're not going to allow any of the banks or institutions to fail. Now, so that part is behind us. Any institution is too big to fail, it's not going to fail, and the RBI will probably find a way to pump in money. The other part is that we are now, after the ILFS crisis, interest rates actually peaked at around 8 to 8.5%, I think, and I was still looking at 9%. I put out several posts saying we can go back there, because I thought that crisis would be more widespread. Also, spreads between high yield and low yield bonds were actually widening for a large part, even in fact till January of this year, which was a big risk. But now I think with the rates really going down, I think the pressure that RBI is putting, and probably you need further action to happen from the government side to bring these rates down, should eventually lead to lower interest rates, is what I'm watching out for. So the simple way to do it is, one is of course you're watching government and policy action. The other way is look at the yields. If the yields sustain below 6%, it's a signal to me that we are looking at lower bond yields, and eventually that will end up translating in borrowing rates. Probably deposit rates need to drop. It may take a while. It may take some time for that to actually happen. And while that actually happens, give me a moment. While that actually happens, we'll probably look at a big cut in borrowing rates for everybody, from which means it has to translate to housing loans, it has to translate to car loans and so on, which is way down the line. Initially it has to translate to the corporate sector. So I think that has not happened, and the signs are that we are trying to move towards that. So if you're able to succeed on the interest rate side, then it will be very similar to what the US did in 2002, where they started to bring rates down to stimulate the economy, and there's always a trigger point. So our interest rates have been, we've been lowering them for a couple of years now, since that peak in yields 2 years ago, and even prior to that we were trying to lower rates. So we are lowering rates to the point where it actually triggers the economy. So far it has not happened, but now that you've got a market crash and lower rates both happening at the same time, you're past the point where markets discount the worst, thanks to the events that have recently happened. Not that the events are pleasant, but they've definitely brought prices to a level where they probably never would be. And so once you move forward, and you do actually, if you are able to sort out the rate side of the problem, so you already have cheap prices, okay, in terms of stocks being down. Once you get lower rates being transmitted, then I think that becomes a trigger very similar to what you saw in 2008. Now people can say, okay, but then that will lead to another bubble. But then if there's a bubble, do you want to participate? So that's what financial markets are all about. You don't always get throwaway valuations unless there's bad news. And the best thing you can do in bad news is realize soon enough that it's bad news to be bought into. And the old saying that, buy when there's blood on the street is easier said than done. Well, you just had blood in the street for 2 months. And there are a lot of people who really didn't want to buy, and are still waiting for 6,000 on the Nifty to happen. So that's the beauty of financial markets, and which is why they're probably heading higher. And once the missed out crowd really realizes that they've missed out on the opportunity to buy value lower, they step in. But right now it will be the stronger hands still buying, because they are still building up their portfolios, using up their standby cash, which is why you'll not hear them come out and say this widely in the open, that this is probably the best value buying opportunity that you had since 2013. And once it's passed you by, you'd probably have missed out on participating on it. Whether the next move up becomes a bubble or not is completely a different question. I think the important question is, are you going back to 6,000, 7,000, 8,000? The odds are that if you do get a second round of effects, which is a second wave of the virus spreading, then probably there'll be volatility in the market, which means you could get one sharp sell off. But I don't think you're probably now going back to 7,500. I think that's the take that I'm taking, or that's the basis with which I'm working forward, looking at where stocks are, where valuations are, and where the trade setups are. I think there's greater confidence to build yourself from here for the upside. And yes, we'll deal with that volatility. We have levels in mind, as in when we reach each level and each things are happening at different stages, you can react to that. You can always de-risk yourself by unwinding a bit, but I don't think even if that second wave thing happens, because I'm not seeing a new low, you'll probably build cash but not go all the way to zero in terms of your positioning, and probably if something like that happens, they'll give you another opportunity. But the problem is we don't know whether that will happen, and you can't really sit back and do nothing about it waiting for it to happen if it completely does not. And even if it does, if there's so much money thrown at it that you do not get that market reaction, then it will again be a miss out. So the right way of looking at it is look for value, see what good companies are available at throwaway prices and you really like them, and then where the risk reward is good, if you've really stepped in, the odds are that things get better before they get worse, and you always have an opportunity to exit. Whereas if you don't take actions at the right time, and that's where timing is important, then you end up taking actions at the wrong time, and then you don't have room to manage risk. I think that's the other way also to look at when you should really act in the markets, is when risk is relatively low, which is what the case was for most of this 2-month period. And I think we've come out of that and need to start looking forward to what happens next. So that's all I think in this very detailed outlook, reflecting on all the news flows that are happening, what has happened last week, the big picture outlook, of course discussed in far more detail with sector outlooks and all in the long short report. So if you've not really read that, go ahead and find it, share this video. And if you want notifications to these videos which I make coming to you, I think you need to just set the reminder on YouTube, and you'll probably get a pop-up every time that happens. So that's all in this update from me. Thank you.